guys, and welcome to our next auditing lecture. This lecture is going to focus on the planning stage of the audit now that pre-engagement is done. So most of our work is going to be in obtaining an understanding of the entity and its environment so we can start our planning. Let's quickly go and have a look at the psycho knowledge levels for the topics we're going to address today. So we are in week 2. We are doing a double lecture, obtaining an understanding of the entity, of its environment, of its internal control, and the business cycles. So we are going to start to learn what transactions this business enters into, what legislations and regulations do they need to adhere to. We're going to get a lot of information about this client that we have just accepted as a client of ours. We are in the first stage of the planning stage. The applicable standard, ISA 315. So if we come into our psycho knowledge levels, we can see at what level psycho requires you to have an understanding. And you can see it here. We are going to be doing this in week 2. You will see that we'll do it in another week as well, but it is a level 3. Our focus here, understanding the entity and its environment. The identifying and assessing of the risks part we will address in week 3. As we keep going down, internal control, the principles of internal control, the responsibilities, the components of internal control are all level 3s. We are addressing these now. So these are all week 2. And if we move down, I just want you to see here, I have not highlighted including IT because that is not addressed in this part. Okay, and then still moving down, the control criteria, the objectives, the layers, the responsibilities, levels 3 and 2. Okay guys, before we get into the lecture, let's just do a quick recap of the pre-engagement stage so that we can see how that affects our planning. So guys, here's a diagram summarizing what the auditor needs to consider prior to accepting an audit engagement. Okay, some of these you can find in a standard, some are purely logical business practice. So basically, can the client pay the fee? This is a business factor. However, whether the staff are competent and capable with enough resources and sufficient time, and whether they can comply with the ethical requirements, and whether the client's integrity is something we want to be associated with, these all sit in ISA 220. There are application paragraphs in ISA 220 that help us with how we consider whether the staff are competent and capable. Do they have the knowledge of the industry? Do they have knowledge or experience with the reporting and legal regulations that this company needs to adhere to? Do they have sufficient time based on the deadline? And ultimately, would they have sufficient staff based on the deadline? The ethical requirements, they say go and refer to the CPC. So the fundamental principles as well as independence. And then integrity, they don't give you much in ISA 220, but you do have to consider whether the client lacks integrity. So help with whether the client lacks integrity. Examples of things to consider you can go and find in ISQM1, the revised ISQC1. Okay, and it says to you, look at things like the business, look at the owners, look at their attitude to the reporting frameworks and to the fee. Are there scope limitations? Okay, lots of things to consider in the standard, in the application paragraphs that help you to determine whether you want to be associated with this client or not. Then the engagement letter, ISA 210. says you must have an engagement letter, and it gives you examples of what needs to be in that. Whether there's a vacancy, ISQM1 says you need to consider this. But in addition, guys, it is just a business factor. Can you actually take on an engagement if somebody else has the position already? And then finally, if this is a recurring audit, are there any significant matters that have arisen in the current year or in the previous audits that make us doubt wanting to accept this engagement again? And this also sits in ISA 220. So all I'm showing you here, guys, is the summarized version of what we've got to consider, but for details of circumstances or examples that help us to make these decisions, I can go into the application paragraphs in my auditing standards to assist me in making this decision. You are going to have to apply this information to the scenario. Pick up where the client's integrity is lacking in the scenario using the examples given in ISQM1. Pick up whether the staff are competent or capable using examples of what they should have in ISA 220. So I need you to get comfortable with these standards. So now we move on to the next standard, guys. We are moving into the planning stage. And before we get into the detail of planning, guys, I'm going to bring you back to the objective, because you cannot plan if you don't know where you're supposed to be going. So our objective, which is our end goal, is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. So for whatever purpose, they should be free from material misstatement, thereby enabling the auditor to express an opinion on whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. Guys, this is in ISA 200, the objective. So we have to get reasonable assurance that the financials are free from material misstatements and therefore would have been prepared in accordance with the applicable financial reporting framework. That's our end goal. So what does it all mean? If I'm sitting here in a planning stage, what does that mean? How does this impact me in the beginning of this? I can see what I need to do or where I need to go. So how do I even start? Well, the first thing I obviously need to go and do is understand what this applicable financial reporting framework is. What is their framework? What is the regulations that tell them how they should prepare the financials? And in our case, it's IFRS. IFRS is the financial reporting framework that says this is how you should prepare the class of transactions, the account balances, and this is how they should be presented and disclosed. But it's not only IFRS, guys. Think about just your studies alone. What else do you know that impacts on those financial statements? You've got other subjects. Auditing will tell you that a company has to comply with the Companies Act, and there are certain transactions that the company needs to enter into during the year that are governed by the Companies Act. And so, for them to be presented fairly in the financial statements, they would have to have complied with the Companies Act. Your tax subject will tell you that there are tax regulations. You've got the VAT Act. You've got the Income Tax Act. There are so many tax regulations that affect the financial statements. So guys, before we can go and do this, we need to understand what is the applicable financial reporting framework so that we can then go and get the reasonable assurance that they have complied with or haven't. And if they've complied with, then we should be able to say they are free from material misstatements. But if they haven't complied, then we will be able to pick up where they haven't complied, and ultimately we will find the material misstatements. So, what happens during the planning stage of the audit process? I've just said that. We, as the auditors, number one, need to go and understand what the applicable financial reporting framework is, and any other applicable regulations that affect the financial statements. We need to know this before we know where to start. What is it that this client is supposed to do? And not just understand what it is, we need to understand how they think they are achieving compliance. So we need to understand what it is they're supposed to comply with, and then how they are complying with it. At least how they believe they are complying with it. And from that understanding, guys, from this, we will be able to pick up where we think there may be areas where they are not complying. Just from this understanding. And then from this, we can come up with a plan with our testing. Where are we going to test? If we think they are not complying, we need to test there to prove that they are not, or to be able to say they are actually complying. So this is what we need to do in the planning stage. It's all about gathering the knowledge so that we have a direction to achieve our end goal. The planning stage is all about developing direction to meet our goal. And as you've heard many a time, and I'm sure your parents tell you this all the time, failing to plan is planning to fail. So that is why, as auditors, there is so much requirement in the planning stage so that we do meet the goal and express the correct opinion about whether those financials are free from material misstatements or not. Okay, so I've now taken the entire planning stage and I've broken it up into almost 3 steps, and they follow on from each step. So the first step, I say, we need to obtain that understanding of the entity, environment, and I've specifically added including internal control. Obviously, that's what we are going to be doing today. Understanding the entity and its environment is going to be gathering that information to understand what the financial reporting framework is and aspects about the business that affect those financial statements. And then understanding internal control is understanding how they feel they are complying with those regulations. Then, the next massive stage in the planning is going to be to develop the audit strategy. And in order for us to develop this audit strategy, we have to do certain things. So we have to go now and calculate materiality. And I'll explain after I've explained the next step why we need to do that first. Then we need to go and identify and assess the risks of material misstatements at 2 levels, at a financial statement level and at the assertion level. Guys, there's a reason now why I left material out there, because you can see I cannot decide which risk could result in a material misstatement unless I know what material is. What do I consider material? And hence why we need to first calculate material. And that is in our first step. Calculate materiality, so now we know what is material, which means when I go and look at the risks through my understanding, I can go and see, could that risk result in a misstatement that could be material or not? So once I have that calculation, we can now consider what's material. I do it at two levels. Is this risk potentially going to result in a risk throughout the financials? So multiple balances and transactions could be affected, in which case there could be a risk at the financial statement level. And guys, just a quick example here. If I think there's a risk that they're not going to be a going concern, then that would be a risk at the financial statement level, because multiple balances and transactions would be misstated if they prepared their financials on the wrong basis. They're not going to be a going concern, their financials will be a liquidation basis. If they are going concern basis, and there's different requirements for how you calculate different balances and transactions if it is on the different basis. So that's why we're saying that risk, if I don't think they're potentially going to be a going concern, would affect the whole set of financials, versus a risk specific to revenue, in which case it's only really going to affect revenue. So I can limit that risk's impact on the financials, which means I would put it at an assertion level. So guys, now you can see why it's so important to get that understanding of the entity, its environment and internal control, because that understanding is going to help us to identify risks. And then coupled with our materiality calculation, we are able to identify if those risks could be material. Okay, then once we know the risks, we need to respond to the risks. So we will respond to the risks at a financial statement level, and our response at a financial statement level is hugely aligned with our audit strategy. Based on all this knowledge we have now, how can we adapt our resources to ensure we are appropriately ready for this engagement because of the risks at a financial statement level? And that is ultimately our strategy. How can we manipulate what we are able to manipulate to be able to reach that end goal for the audit? And then once we have adapted our resources because of the risks at the financial statement level, we are then able to take the next step in the planning, which is to develop our audit plan, which is going to help us to respond to the risks at the assertion level. So, important there to note, responding to the risks at a financial statement level is addressed by the audit strategy. And responding to the risks at the assertion level is our audit plan. Okay, but as we get into each of those, we'll be a lot more comfortable. So guys, next week's double lecture is going to address all of these. Step 2. And then our last lecture is going to cover the audit plan, responding at an assertion level. So without further ado, let's go and look at what we need to understand about the entity, its environment and internal control so that we can pick up risks.